All of this positive action, though, coming amidst thing number two, more recession calls. That's followed last week's Fed rate hike and market sell-off. This morning, Goldman Sachs is coming out, and in a note to clients, the bank raising its recession probability from 15% to 30%. And this is in the next year. Goldman Sachs chief economist Jan Hatzius saying part of the reason for the revision was that recession risk is, quote, now higher and more front-loaded. So you have people like him on the one side, and then on the other hand, you have people like President Joe Biden, who doubled down on his stance that a recession is not inevitable. Over the weekend, he made those comments.
No, I don't think it is. I was talking to Larry Summers this morning, and there's nothing inevitable about a recession.
To be clear here, Goldman Sachs isn't saying it's inevitable. I mean, it's still 30% is still pretty darn low for a recession to happen in the next year.
Absolutely. And when you look at some of the warning signs as well that we're keeping in close mind and really kind of just looking across what the consumer is experiencing at this point in time and the pullback that we've seen in stocks. So you put the economic data together with what is already kind of being pre-forecasted into or priced into the stock market right now is the probability of a recession. And then even further, we're going to be watching a continued tightening from the Fed. They're going to be looking to dampen down inflation. Consumers along that route, we might see less of the opting into some of the mortgage rates. We're already seeing that showing up in some of the housing data as well. And we're going to be breaking down one of those particular housing companies to really read through some of the tea leaves there and understand better where it's actually showing up in some of their order demand as well. Because along this broader route, there are a few things that the Fed can't have any control over. It's the supply chain crisis. That's something that's still going to have an outsized impact on the consumer. And then additionally, the Fed does not have control over where consumers are going to continue to react to the pricing that companies, quite frankly, have to continue to enact because they're seeing wage pressures at this point in time. They're still navigating the same supply chain issues. And so all of those things considered, it's the stock market trying to price in the probability of the recession before it actually happening and showing up in the data.